Wall Street's early reaction to what is being perceived as a new investment class here?
That's right. I think that's the right way to describe this. A lot of people have been kind of distracted by the headline figure of $500 billion. The real news here is that they're trying to create a product, a new investable asset class, an asset-backed finance class that, could be akin to things we see with aircraft leasing or accounts receivables. Those are all kind of established ABF. Yeah.
A farmer grows wheat, sells against the future crop to get the cash flow. This is Nvidia transferring some of its financing, correct me if I'm wrong, and maybe some of that risk to Wall Street and thus maybe to our audience, because ultimately I'm willing to bet these will become things that we can all just buy.
So here's a way to think about it is, when you go to purchase a car, think about the car like the chips, for example. You go there, you could pay cash for the car if you want to, or you can finance the car. And there's an established depreciation schedule for the car. You kind of know what the collateral will be. All that's been established. For chips and for compute, that hasn't been established. There are other parts of the AI infrastructure industry where you already have ABF established in data centers and other parts of the ecosystem. But in terms of chips and compute, that has not been established because the depreciation is a little wonky. People haven't necessarily wrapped their head around what future cash flows may look like. So what this does is it basically establishes the market. It establishes the product. It has these 6 financiers who will come in and say, if you want to finance chips, you don't have to go sell tens of billions of dollars in debt in order to pay for the AI infrastructure build out, in order to pay for these chips. We'll arrange a financing plan for you. I think the big question is going to be at what price? And this is something that Jonathan Gray of Blackstone alluded to, that in the beginning, you're going to maybe deal with some, cash flow negative counterparts. The pricing could be high, but over time, they expect that to come down and get more of the broader banks involved as well.
Ed, does any of this bother you?
Well, it's kind of early to really express a strong opinion on it. So far, I have the same reaction as the market, which is kind of ho-hum. It's first of all, it's a memorandum of understanding, and memorandums of understandings don't have a real good track record recently. So it's just, that's all it is. There was no specifics about how it's going to happen. I see an analogy with REITs, kind of for data centers. We have those already. And those are kind of financial platforms that invest in the data centers. And, those have gone up. They've gone down.
If because you're widely followed, so let's say a retail investor said, and again, I don't know if this is exactly who this was marketed to, but said, there's an opportunity for me to pick up, I don't know what the number is, like 8, 10, 12%, maybe less. This is a couple year, 2-3 year thing, asset-backed financing deal, and it's being backed by basically compute, some way, maybe rental income streams. Would you have any problem with that, or could that have a reasonable place in people's portfolios?
It could have a reasonable place, but I think it's going to be asset by. I don't think it's that you buy the asset class across the board. You're going to have to be pretty selective, and I think there's a little bit of hype so far in this whole thing. Calling it an asset class, it's a factory. It's a data factory. So I don't know that we're really creating anything radically new.
So the idea is that if you securitize chips and compute and sell it off, then it's not necessarily a circular financing situation. That's Nvidia's take. Do you think the broader market believes that?
I think there's an idea that at least now people's retirement accounts are involved. So you're spreading the risk a little bit beyond just a small group of tech companies that are both Nvidia's customers and potential competitors. What's interesting is in my conversations with investors this week at these top AI labs, some of them say the $500 billion isn't even enough. It's going to put online about 10 gigawatts, which is what we're expected to need next year alone. So while that sounds like a huge number to us, $500 billion, to the AI companies that see compute as the future of our entire economy, it feels like that number barely scratches the surface.
So then, just to be clear, who will the borrowers be? Who couldn't just pay cash outright for access to compute and chips that now will opt for the financing route to get access to this?
Part of it is some of the neo clouds and the neo labs that are some of NVIDIA's biggest customers. Think about a CoreWeave, a Cerebras, for example. Some of those companies could be turning to this financing, but we also don't know any of the details of these deals just yet, and none of them have actually happened yet. We also don't necessarily know the degree to which NVIDIA is going to be on the hook for some of that debt as well. So I think that's going to be one of the key questions. And then also, what the demand looks like for GPUs as a security is something else I'm going to be interested in. Obviously, there's so much demand for AI across the board. I'm sure investors are clamoring to get into it, but one of the key questions is what the value of these chips is going to be long term, and if that's going to be a fungible asset and one that, again, people want to be invested in longer term.
The broader criticism, even before all this, of so-called circular financing, people would sort of tag it as vendor financing, which is something that's existed for a long time. I mean, the problem there is if the seller of the equipment, Nvidia, is lending the money that becomes their revenue, and there's really no productive use for it. In other words, wouldn't have been a customer otherwise. We're in a situation now where, at least if you listen to everybody in this business, there's just not enough, as you say. And so, therefore, we're facilitating the installation of this compute that's going to generate revenue because there's so much demand for it. Yeah. And maybe it kind of lets you sidestep the concerns about the vendor financing.
Right. Let's turn the CapEx concerns that Wall Street understandably has into an investable asset class, and then all that CapEx is totally fine. Right. So I think that's very well said.
Do people believe that it will be an investable asset class? Is that gaining some traction among investors?
Absolutely. I mean, a year ago, I covered this startup, Orn, which you guys would think is hilarious. It's these 20-somethings in a FiDi apartment who are doing $1 billion worth of GPU trading from this small townhouse in the course of just a month. And we know that CME, ICE, all these companies are trying to get in on GPU futures, spot trading. OpenAI is hiring finance team leaders that are going to work on GPU security. So this is something that there is a lot of demand for, sort of treating compute like a commodity, the way we treat oil, for example. But one of the...
Or the way Enron treated electricity.
Exactly. I think that is very well said.
That's a different ending. But I will say, to your point, 20 years ago, and it may still exist now, I'm dating myself, people traded DRAM. And was a tradable market. Right. And I think they're just trying to do the same thing. And who can blame these people, these guys in this warehouse, bros, who maybe are forgoing a romantic relationship to work on their AI ambitions, Madison?
I see you see the stories that I'm working on.
That's a story that you're working on. Maybe you guys know somebody. Why not get ahead of it? Get bought by a bigger firm, get rich.
And get over $30 million from Andreessen, which is what happened to those guys as well. And, this is part of the broader demand story. We had Greg Brockman talking to Axios, one of the co-founders of OpenAI, saying that we are going towards a compute-powered economy. The people working at these AI labs see compute demand is never ending. It's something that'll never be satiated. So then if you have that belief, again, $500 billion is nothing.
Well, I think that the key question and what's changed potentially now and why this announcement is coming now is this idea that historically you wouldn't be able to securitize something like compute or chips because you didn't know the residual value. You didn't know how it would depreciate and what that meant for collateral. And then also the direct tie-in to revenue. And when you talk to people, do they tell you that's changed now just because of the business models of the LLMs? And how much faith do we need to put in to an OpenAI or an Anthropic in light of all this, especially if we're looking at, $500 billion market, potentially?
Exactly. One investor who I talked to yesterday told me he's worried about something called diminishing model returns, this idea that we already have these really amazing models, and it's not clear that the AI labs are going to need as much compute going forward to train better and better models because Fable 5, Fable 7, whatever, it all starts to sound and look the same after a while, especially because the majority of people aren't needing the frontierest of the frontier models. I mean, look at what's happening with Google. They've already decided to kind of, for better or worse, roll back their AI ambitions because they went free cash flow negative and there was not necessarily a great reaction to that. So that's one of the things that the bearish investors I talk to are worried about, that AI labs that are all in on compute today, they may longer term not see as much return on the models that they are training that are really expensive and need all of that compute.
Yeah, I think the analogy that Jamie Dimon uses is you're not going to take a Ferrari to go buy eggs at the grocery store. You don't need it for that purpose.
Exactly. You can do your Ford for that.
Yeah, absolutely. Yeah. Madison, thank you.
And then there are the persistent longer-term questions about how long this is going to last, right? What is this cycle? There was a really interesting piece in Bloomberg this morning by a macro strategist named Simon White, who was drawing parallels between NVIDIA's new financing scheme and AIG and the housing crisis, right? And that AIG didn't think it was taking on risk. It was trying to offload all of that risk. And eventually it was. And he raises the question of whether eventually you will actually have a glut in chips that masks underlying signals. In other words, if there's all this cash out here to build compute, do you have a real read on demand if the push is such that you're building whether anybody is actually utilizing? I mean, if you look at the capacity utilization now of these GPUs, it's not super high. So I just think there are a lot still of longer term questions.
Well, that gets to the cyclicality also of chips, which is a question that on Wall Street is saying, oh, now it's perhaps these are longer cycles that you have, and also these chips, how long do they last, and how do the companies put those on their books as well? But this really gets to also the point of AI capex, how much spending is going on in this, and you're seeing the markets at all-time highs right now. If the markets were not at all-time highs, and if we were going on a 10% downturn, would you still be seeing this amount of capex?
Green across the board today, so a little bit of relief, obviously, after the CPI print. Certainly the AI bulls getting a nice lift from Supermicro and CoreWeave, the beats, the raises, et cetera. And Ed Yardeni goes to 8,400 now on the S&P. 8,250 was the prior target, which at the time he said could be a little conservative. All right, so the words, then the action. So he raises it. Says, quote, we've never seen consensus earnings expectations rise so quickly for the current and coming years as they have since mid-2025. The result has been an earnings-led melt-up in the stock market to record highs. That's where we find ourselves. There's no reason to think that that's going to change as long as the earnings picture remains what it is.
No, and congratulations to Ed on calling the 20s for exactly what it is. It is the roaring 20s, specifically attributable to the earnings growth. Now, Ed is the highest on the street. If you look at the S&P targets, the actual consensus price is 78.45. But we're looking now at taking profit margins towards 17%, which is absolutely staggering if you think about where they were just 5-6 years ago, kind of wallowing around 10%. The earnings growth is the driving force for sure. Ed right now is the highest on the street. And I think what we will benefit from is continued participation as we move higher from the systematic funds. We're kind of sitting in place right now off of this 3% gain that we've had in the month of August, really strong out of the gates. But I'll tell you what, we break out above that August 5th, 77.93 high. I expect systematic to engage further and move the market towards 8,000.
Okay, so I mentioned, obviously you get the news that you really needed, Bryn, today. Does the Yardeni target sound reasonable now to you? Because I said yesterday, I think 8,000 is the floor. It feels like it from the street, at least. Everybody's gotten now to at least 8,000, or certainly most people are getting there. And now he ups the ante at 8,400 because of this FEMO, right? Not FOMO, FEMO. It's the earnings-led momentum.
So I typically, ignore year-end price targets. That being said, Ed's been doing this for decades. He has a very good track record. And so I think directionally what he's saying makes so much sense, because you also have to think about how the construct of the S&P and the NASDAQ, but for the S&P for earnings has changed so much. So yes, Nvidia is still the #1 holding in the S&P, but now Broadcom and Micron are also in the top 10. Obviously, Broadcom's been there for a minute, but Micron's now broken to, I think it's like #7 or 8 position. And those earnings from those three companies are going to continue just to be monster. And so I think if you are looking at earnings from these specific companies, especially the Micron Nvidia, you can math out very easily why his number at 8,400 sounds plausible. And so I do think investors do need to understand that huge shift of the constitution of the S&P and the NASDAQ has changed, which is going to continue to push those earnings growth numbers higher.
Shan, what do we think about this market?
Well, I mean, the crazy thing, right, is that the S&P 500 is actually underperforming other global equity markets. And so I think if you look at the tech PE ratio, we've seen that compress pretty markedly. We're seeing the opportunity for this pivot, if you will, in terms of the next phase of AI. But I think it's most important to kind of counter some of the enthusiasm with the fact that many are still concerned about like the recent unwind in memory. Was that fundamental? Feels more technical to us, certainly the degrossing. The reality is, too, you also have the news from Nvidia about these memoranda of understanding. That clearly is indicating that there is going to be a wider participation. We've seen it in the credit markets already in terms of funding investment, this issuance, increase in investment grade issuance. You're seeing it now utilizing the alternative private equity managers, private credit managers to also fund this growth. The bottom line is that all of this is underlying the economic momentum that we have globally. We're no longer, especially here in the U.S., Scott, our economy is not based on what's happening with the consumer. And so all of these concerns about the labor market and inflation and the Fed, the reality is that the tenor of economic growth has changed in the United States, and the companies that are performing well from an earnings perspective are benefiting from that and are likely to continue to benefit from that, even if there are pockets of weakness in parts of the consumer market, for instance.
Big week for the AI bulls, undoubtedly, right? The Nvidia financing news, no money to be seen yet, obviously, but the announcement enough speaks to the environment and the expected demand that's going to be there. CoreWeave blows it out, stocks ripping. Supermicro gives a good guide, stocks higher. So this has been a week of AI trade validation in many respects.
It's been about validation. It's been about the messaging and how they're doing it. Remember, people were worried about how and why companies like Oracle and Microsoft going out into the private sector and gaining debt. This consortium, even though it's still not completely tied together, this consortium in terms of how Nvidia put this together, number one, and number two, how they communicated it, Scott. We need information in the market, and they did a great job talking about how that's number one. Number two, in terms of the tech trade, we've said for 10 years that tech is becoming the consumer staples of the U.S., period. And so earnings have become excessively stable, but Ed nailed it. And we talked about this on the show yesterday. In the second quarter, we've never seen in the history of watching earnings revisions for well over 30 years, we've never seen a revision of earnings like that. And when you see that, that is real. That is real. And so what's going to end up happening is you're going to continue to see these types of revisions over the next 4 to 6 quarters, and 8,400 is clearly